If you have questions, just hit me in the chat and we can go from there. But I'm gonna let everybody know we're gonna in a minute. Okay, so what we're going to be talking about is trading psychology, and we're really going to be focusing on the concept of risk versus reward. So, we're just going to talk through kind of the concepts of risk and reward. Yep, I can do that. So basically, we're just going to talk about risk versus reward, how it plays into your trading, and why it matters, right? So, risk versus reward. So, to put it in simplest terms, you're trying to make more money than you're willing to lose when you take a trade. Like when you go and place a sports bet, a lot of the times you're gonna bet $50 to make $50, which is pretty normal in betting. That's why most people don't make money betting. In trading, it's a little different. You can risk $50 to make $200. You can risk $50 to make $1,000. You can risk $50 to make $1,500. It doesn't really matter what the risk to reward is. The point is that you get to control that when you are trading in the stock market. So, like, you have the opportunity to choose how much money you're willing to risk and how much money you are planning to make on this trade, and how much you're willing to risk to see if that plan works out. And you want to have a good risk to reward ratio, because that's what makes trades worth it. That's what makes the big winners. That's what keeps you alive in this trading game. So, first point I got here is the amount of money you lose is the only thing that you can control. I'm sure you guys have heard me say this 1,000 times, but the only thing you can control in the market is how much money you lose. So the better you manage your risk, meaning using good stop losses, sizing appropriately, and just controlling how much money you lose, that will keep you in the game longer. And it's the only thing you can control. So why would you not take advantage of that? Okay. Next thing, we want to look at our sizing. So we don't know which trades are going to work. This is tying into point 2. Every trade is random. You don't know which trade is going to be the big winner. You don't know which trade is going to be a loser. You don't know which trades are going to win, which trades are going to lose. So you have to go in with that mindset that you don't know. It's important to have an edge, but it's also important to make sure that you are trading with consistent size. Because if I don't know which ones are going to be big winners and which ones are going to be big losers, then why would I size any differently on these things? It's like sports betting. I would bet the same amount of money every single time. Okay. So risk versus reward is sizing appropriately for every trade. So if I don't know which ones are going to be winners, I don't know which ones are going to be losers, I need to size the same every time, because maybe this time it'll be a big winner, or maybe this time it'll be a loser, or maybe this time it'll just be a normal winner, or I'll get stopped out at entry. You never know. So you always size the same, so that way you don't get caught up in sizing poorly and then not having consistent results as a result of that. So you don't know when you're going to lose, or you don't know when you're going to win. So the point is, size the same every time. You just know you have a strategy that is consistent. So when you have that consistent strategy, you know the odds are in your favor, but you don't know which times it's going to be in your favor. You just know over a large capacity of trades, 100, 200, 500 trades, you know the odds are in your favor. You don't know this trade or the next trade are going to be those winners or losers. You just don't know. It's a numbers game. We're paying attention to the sample size, so we need to always size the same as if we don't know if it's going to be a winner or loser. We just know it's going to be a profitable strategy over the course of a large number of trades. Okay, so that's point number 2. Let's see. Think in terms of this. If I win this trade, I can have blank more losers and still be profitable just from this one trade. A lot of times I like to think in this way in terms of when I take my trade. Like, okay, if I take this trade, how many more losers could I have as a result of having this one be a winner? Like, basically the idea of risk to reward. So like, I'm always risking the same amount on every trade because I don't know which ones are going to be winners. I don't know which ones are going to be losers. So I risk the same amount on every trade. So I always know how much I'm going to risk every single trade. It's always the same. So if it's always the same, then that will always be a variable of 1. So let's say I have a $1,000 account and I only want to risk 2% per trade on any trade that I take. So I'm only going to lose $20 per trade. If I only lose $20 per trade, then I know that's going to be my variable of 1. So when I'm thinking in terms of risk to reward, I'll draw it out for you. So I'm going to be risking 1. For my account in this example is always going to be the same. So if I have a $1,000 account and I'm risking 2% of that account, that's always going to be $20, right? It's always going to be $20. So I think it's just a good standard 2% for any account. So if you have a $10,000 account, it would be $200 loss per trade. But this is always going to be your variable of 1. So when you're looking in terms of taking a trade, I'm going to go through an example here. So like, we'll just say a random example. Okay, let's say you get in right where we're at right now on this chart. And I'm going to draw a risk to reward box. This is my entry. This is where I'm going to get in. Say I got in at this exact period of time. And my stop loss is going to be just above. So I size my position in this trade when I get in here to have a $20 stop loss. Just stick with me for the sake of the example, that 2% mark of my account. So if I had a $1,000 account, I would only be risking $20 right here. I know that. Now, when I go and draw my reward area, that's going to tell me how much profit I could potentially make from what I'm risking. So say this is the $20. I size appropriately. So this is the $20 that I will lose. And then this is the potential gain I can have. So in theory, I'm really risking $20 to make a little over $40. 2.28 is the risk to reward. So this is my risk. I'm looking for it to come all the way down to here if I'm taking puts, and this is my reward. Okay, so that's where I get 2 to 1. This plotted area is what I'm risking because I'm getting in here. And this plotted area is my reward because that's what I'm looking for the stock to do. And this is how much room I'm going to give it. Okay. So putting this in simpler terms, I'm not going to use the example. I'm just going to do risk. It's always going to be 1 when you're talking about risk to reward. And we're going to call this as an example, 2% of your account. Do what you want. If you want to do 5 and be really risky or whatever, you can do that. But 2% of an account is a good standard. I typically use that. Okay. So reward, this number can literally be anything you want it to be because that's the whole point of trading. It's not always a 50-50 game. You can make this could be 5, this could be 10, this could be 2, could be 3, whatever. It just needs to be bigger than 1, preferably at least 3. So I'm risking, like in theory, I'm risking $1 to make $3 on any given trade. And if the potential is less than that, then I'm not going to take the trade because it puts things on my favor. Okay. So this is how you need to be thinking when in terms of creating a trade idea. Is it even, sure, there might be a setup there, but is it even worth taking? I noticed a lot of people in the Christmas challenge were taking trades that, yes, they had a setup, but was the risk to reward there? Some of the time I would say no. I used to fall victim of that and take trades that looked good on paper, right? The chart looked good, but the risk to reward wasn't there. So it wasn't even worth taking the trade, even though it looked good. Risk to reward is the number one thing that we are trading based out of. It's the foundation of our trading, my trading at least. Okay. So reward can be anything. And this is going to be your planned return on. Okay. Next point. Risk versus reward trading only works when you follow your plan. Okay. So let's go back to this example, saying that I got in right where we're at on this chart. Okay. Say that's where I got in. This plan is only going to work, and it's only going to be a risk to reward of 2.28 if I hold to my target. It will only be a risk to reward of 2.28 if I stop out above this, my stop loss, above this high. It will not be a 2.28 risk to reward if I stop out here, or I stop out here, or I stop out anywhere in between this area of where I said before I got in the trade where I'm going to stop out of. The risk to reward will not be 2.28 if it goes to here and I take profit. If it goes to here, if I take profit. If it goes to here, I take profit. If it goes to here, anywhere in this area, I start taking profits, my risk to reward instantly goes down. But as soon as it goes to here, I got that 2.28 risk to reward. So some people may say, oh, I'm taking a trade for a risk to reward of 2.28. But in simple terms, they did not, because they're taking profits right here, way before they said they were going to. So they were risking way too much. Okay. I think that makes sense. Let me know if that doesn't make sense. But last point I want to make, pick contracts based on the expected move. Okay. Every stock has an expected move. You can find this on wherever you're picking your contracts at. So I'm going to stop sharing my screen for a second, because I don't need people watching me log into my program or to TD Ameritrade, but I want to be able to show you guys what I'm talking about. Every stock has an expected move. And I'm going to show you what that looks like. Just give me a moment here. Hold on. Minor difficulties here. Bear with me. I'm getting there. I forgot that I wanted to show you guys this. This is something I've been using a lot recently, just so I don't get caught in a smaller move than I would like. Okay. So it's pulling up. Okay. All right. So expected move. We have all these options contracts and there's numerous ones to pick from, right? And one moment. And we have these, we've talked about the different elements of options contracts, but one point we haven't talked, or we have talked about this, the implied volatility. So what this is basically a reading of how much, it's hard to explain. You're going to have to watch the options contract video if you don't know what this is, but this isn't the important part right now. It takes a while to explain, so I'm not going to do that right now. It's basically how inflated price is, the stock price or the options contract price is. If this number is high, that means the price of the contracts, they're very overpriced, essentially. But the point we want to pay attention to is this number right here. So this number right here, if you're having trouble picking contracts, this is going to help you as well when you're deciding to take a trade. So what this is the expected move for by the time this contract expires. So these contracts expire December 16th. We look here, this has a plus or minus $12.56. So this means that there is a implied move. The market makers think that there will be a $12.56 move in one direction or the other by the time of this expiration. So how can we use this? Okay, we're looking at a trade here, right? Say we want to take puts. Just bear with me. Fast example. Say we want to take puts because we have a level right here. We have this level right here. Okay, so we take that puts based on the break of this level. And we're looking for a profit target. So let's say our profit target is just the low of this candle here, okay? So we're just making a quick trading plan. I wouldn't do this normally, but just for sake of example, right? We broke this level, so we took puts, okay? We enter puts, we think it's going to go to 140. So what we're looking at this here is we entered it at 144.92. Let's say we got it at the close at around that level. And we're looking for basically a $15 move. Let's go look at these contracts. Let's take a look. And it says we have a $12.56 move. So our thesis most likely will not play out within a week because these contracts expire on Friday and the market makers do not think that there is going to be a move of bigger than $12.56, which means this move is a $15 move, which is out of the expected range for this week. So what we can do is we can go look at this further out contract. See, this has $16 move. This can help us pinpoint a good entry or a good expiration date for our trade ideas. So you're expecting a $15 move here. So you go look for something that fits in that $15 mark. So this week's expiration would not work. Next week's would, because there's a $16 move that is implied by the market makers. And then the expiration after that would work, the one after that, the one after that, and so on and so forth. Because there's more time, there's more expectation for a bigger move. So like, for example, these contracts in January of 2025, they're expecting a price movement of about $124 in one way or another. Okay. So we can go to another example and then that will be it for this. Okay. So let's say we want to take Apple calls. Okay. It's holding this support level of 141. Let's go to the contracts. Let's look at this week. Let's pick our price target first. I already got this level drawn, the 148 level. So we're looking for, if we got in here at about 142, we're looking for a move of about, what is that? $6. Okay. So we are looking for a move of about $6. So we're going to pick a contract that fits within that $6 price movement. Here we go. $6.59. This is probably the perfect contract for us to pick. Could be a little risky to have that big of a price movement, but we could pick this contract that has an $8 move that expires the week after. Does this make sense? Seems like it's pretty simple. It tells you exactly. The only caveat you have to do, what you need to do anyways, is pick your price target. So when you pick your price target, you can figure out which contract to take based on the implied move. Okay. Yeah, you like that? That's a good one, isn't it? All right. So that can help you figure out the type of premiums you want to spend, and just help you better plan out your trade and kind of play with the market makers almost. It's similar to the concept of betting the spread on any of these things here. It is pretty interesting. Like betting the spread on the Panthers game that just happened. Okay, now I can go look for some bear flags if you'd like me to. I'm gonna do it here. And then anybody have questions? That's all I got for this. Like that's when it comes to trading risk to reward psychology, that's all I got. Yeah. Okay. So I hope you enjoyed that. Now I'm going to go look for some bull flag and bear flag examples. Okay. If I go to a lower time frame, it might be easier. This is a bear flag. I mean, it's not the prettiest bear flag, but this is still a bear flag. All a bear flag is a move down followed by consolidation, which ends up forming, it doesn't have to, but typically will form some sort of channel. And then ultimately will break down. And the first target would be at the low of this initial move down before it creates the bear flag. What's your usually loss profit ratio for stop loss every trade you do? I usually like to size for 2% of my account per stop loss per trade. So 2% of my overall count. And I use that the same every time. And sometimes I will just size the same into trades. Like if it swings, I'll just size the same amount of money and for every trade. So that way, if it goes poorly against me, it won't affect me too much because I've sized the same every trade. For swings, though, that's usually what I do for swings. Okay. So bull flag is an impulsive move up followed by consolidation, okay, and then that as well typically forms some sort of channel that ultimately breaks the upside. So if I can think of some off the top of my head, which a lot of them just came to mind actually. Okay, so these are ones that have happened in the past. Meta. Okay, this is an example of a bull flag on the weekly time frame right here. They're not going to look picture perfect all the time, but they are recognizable. Okay, here's one here. Amazon. I did watch this one the other day. Nope, maybe I didn't. Okay, let's see. Apple, let's see if Apple has this. This is a bull flag that failed to break out and broke downside here. So they don't always work. So as you can see here, it looked like a bull flag gapped up. All these people started buying calls because it broke out of this bull flag. Was a liquidity grab, pulled it right back down, stopped everybody out. More people probably tried to get back in, and then boom, it had to move down back to the downside. So missed out on the expected move portion, but does it typically take into account plus or minus? So whenever you look at it, it will be updated. It's continuously updated throughout the day. So this or it might be just for the day, but the expected move, this like on Wednesday, this number will be different. On Wednesday, this number will be different. On Thursday, the number will be different, but it updates throughout the week based on the expiration and what they expect the move to be by the time of this expiration. So it's always updated. More bull flags. Here's a bull flag. Right here. Maybe a bear flag. Maybe I can find a bear flag. This is a bear flag. If you look on the weekly time frame, strong move down. Here's the pole. Bear flag, breakdown. Here's a bull flag. All right, I'm gonna show you one more and then I don't want to do any more. Here's a bull flag. And if you need help with these, feel free to send all your charts and I'll tell you if it's a bear flag or bull flag. That's a bull flag. Reason why, this pole right here, this was the impulsive move. This is part of the impulsive move up. Flag, breakout, couldn't hold it. Okay. Do you have preferred stocks to play options on? I have a list. Yeah, I have a list. It's a pretty extensive list, but I go through it on Sunday. I pick my like 8 stocks. I give you guys my watch list every week. I put those stocks in my watch list, and those are the only ones that I watch for the week. And then I start over on Sunday again and pick the stocks that I want to have on my watch list for the week. And it's typically about 8 of them. But here's my list. I can't read them all out to you, but here they are. So it's probably about 100. I would guess 77. Just random stocks that you pick up over time. All right. Anybody else got questions? You good? Make sure to start using that expected move thing. I found that to be very helpful. But all right. Thank you guys. Let me know if you have questions in the chat. I will see you tomorrow. And yeah, have a good rest of your night.